Right. Okay. Hi, everyone. Good
Hey.
morning. And welcome to Saxo's weekly market outlook call. It's called the Saxo Spotlight. I'm Charu Chanana. I'm a market strategist at Saxo Singapore. And I'm joined today by my colleague, Jessica Amir from our Sydney office. So I will first just share my slides, maybe. Okay. I guess you can see my screen now, right?
Yep.
Okay. So I think just starting off, what did we really get this week, past week, right? So some more fears on the banking sector, both in the US as well as in Europe. And we still have some bank names flashing red, as you can see on the right side here on the slide. Um, on Friday, we got some data out of US, which actually showed that deposits dropped by $100 billion, mostly from small banks. So that created some jitters again. There's a flee of deposits happening. Then we had some unconvincing comments from Treasury Secretary Yellen, but basically the bottom line is that the market continues to be fragile and vulnerable, and basically just waiting for potentially another shoe to drop or something. We did have a little bit of a bounce in U.S. regional banks after Yellen's call for an unscheduled financial stability oversight council meeting. That was along with the Fed Chair Powell as well. But the post-meeting statement also again kind of is short of detail. So the nervousness in the markets has obviously continued because of that. And on the other side of the pond, in Europe, the latest that we have after the credit series, and we discussed the 81 on the last Monday call as well. But the latest scare that we have now is on Deutsche Bank. But again, I think markets are being very fragile here as well, because what really triggered this was that Deutsche Bank actually said it'll redeem a tier 2 subordinate bond early. Now, usually such moves are intended to give investors some confidence in the strength of the balance sheet. But again, being as fragile as they are right now, markets did not take that news positively. CDS rose to record highs, and the stock was down 15% at one point on Friday. Then the other thing that we got last week was the Fed decision. So the Fed, after ECB's 50 basis points rate hike, actually also did go ahead and hike rates by 25 basis points last Wednesday. The dot plot, as you can see here on the slide, didn't move much. They are signaling terminal rates of about 5.1% still, which is the same as what they had signaled in December as well. The market pricing is still quite lower than that, which means that we are either already there or at most we get another hike of 25 basis points maybe in May if bank concerns don't flare up, that is. But the real discrepancy between what the Fed is actually showing us and what the markets are actually anticipating is in rate cuts, where the Fed is actually still saying that they are not going to cut rates in 2023, but the market still expects about 100 basis points of rate cuts this year. But again, the key question here is, even if the Fed was to pause now, or maybe even start cutting rates, I think cutting rates is a bit of a stretch. But even if you think that there's going to be no more rate hikes from the Fed now, is that still bullish for the markets? I mean, I think that's a key question, and we can try to answer that today on this webinar, perhaps. But first, I mean, just again summarizing here, look at the markets from last week and what did we get really. So equities, as you can see here, up more or less, driven by a fall in treasury yields. And also another reason for that could be some cautious positioning. Many investors had already scaled back their exposure to equities. Last year, we had 20% kind of decline in most of the major indices, and so I think ahead of that bank collapse, the positioning in equities was quite bearish already, which was actually a complete, again, contrast to bonds, where investors were mostly betting on higher and rising interest rates still. And those expectations, as we've just talked about, they've completely reversed in a big way following the crisis. So I think that has a big role to play on why bonds, fixed income are reacting in a big way to this bank crisis, whereas equities are still kind of muddling their way through. But I think the other important trend that really want to highlight here before I hand over to you, Jess, is about investors actually flocking to big tech amid this banking sector chaos. And what does that mean? So I would just bring you to the slide here. I have shown here on the slide the performance of NASDAQ 100, which is a proxy for big tech, I could say, and Russell 2000, which is a proxy for small companies. So since the start of this month, if you look at this chart, you can just clearly see how evident is the divergence here. And what's really driving that? So of course, one, lower yields, lower rates, which typically provide a boost to companies in high growth areas such as tech. So those large cap companies are the ones that usually drive the Nasdaq 100. Or also, I mean, if you look at S&P 500 again, it's the same case there as well. You know, Apple and Microsoft have climbed 9% and 12% respectively this month. Google's parent Alphabet, it's up about 17%. So I think as these higher weight companies in the index, as they rally, obviously these indices are also showing a good performance. The broader index is holding up because of the rally in these bigger companies, but under the surface the breadth is actually quite weak. Meanwhile, the smaller companies, the Russell 2000 as represented here, that has obviously been disproportionately hit by concerns that problems in the banking sector could lead to a credit crunch, and it could just make it harder to borrow money and operate their business models. So I think we are actually at Saxo becoming quite conscious about the fact that we could see a lot of bankruptcies in the coming months. So stay cautious about that. And obviously that flight to quality with this kind of a sentiment setting in, with a sentiment on credit crunch, a sentiment on a recession potentially being coming faster than what was earlier expected. So these mega cap companies, which are a little bit less reliant on credit financing because they have a lot of spare cash of their own. So this flight to safety, flight to quality is also helping these big tech stocks. So potentially, I think there's more room for this Nasdaq versus Russell 2000 trade if you want to use that as a spread or just some absolute exposure out there. But I think that's something interesting that I wanted to point out. But I'll pause here. Maybe Jess, you want to take up what you're watching from here?
Thanks, Charu. So I think it's really interesting. So you're just pointing out the mega caps. So we can see that here on Saxo's equity baskets. The mega caps, which you can see, they're about 1, 2, 3, 4, 5, fifth to the top there. We can see year to date, they're actually up 12.2%. So that's the mega caps across the global investing universe. But if you step back and take a look at the NASDAQ 100, which Charu was just showing on the prior slide, pardon me, sorry, prematurely sliding here. With the NASDAQ 100, we can see the top line, the NASDAQ 100 is actually up 17% this year. So that's quite phenomenal. But if we just think about some key names now in the mega cap part of the market that are also in the NASDAQ 100, which is a very commonly traded indice across Saxo. We've seen NVIDIA shares, they're up the most this quarter in the NASDAQ 100. And so it's worthwhile just pausing on this. So NVIDIA has got several large components to their business, and their data center and their networking business. I guess that's where they get the majority of their revenue, and that's been looked at by investors and traders as a defensive play. So NVIDIA shares, wait for it, they're up a phenomenal 83% this year. That's just extraordinary. Also in the NASDAQ 100, obviously the biggest stocks in the NASDAQ, which is also in the mega cap Saxo equity theme basket, which you can see there. We've got Meta shares, which is the owner of Facebook, of course. Meta shares are up 71% this year. Now, the fact is, as Charu just pointed out, and just reiterating why our clients are bunkering into tech, it's a reason because they've got strong, repeatable cash flows. And, look, Meta has taken a hit over the last couple of years. Their revenue actually declined in 2022, but the market is now expecting a recovery in 2023 in terms of earnings per share. So that's something to consider. That's why investors are perhaps buying into Meta. Tesla shares are also doing really well this quarter. They're obviously in our Saxo mega cap equity basket. And Tesla's, of course, in the NASDAQ 100. And Tesla, it's really worthwhile pointing this out. The lithium price is actually down 47% this year. And that is obviously supporting Tesla's bottom line. So that's a consideration for you as well. Another thing to also consider, if we can just fast forward out. Actually, sorry, I will stay on this before moving on to gold, pardon me. So if we also think about the mega caps now, thinking about mega caps that are in Europe. So in Europe, you know, you've got the Stocks 600, which is the largest 600 stocks across Europe. We've seen phenomenal gains in the defense component of the Stocks 600. And a defense name that comes to mind is also in Saxo's defense basket is Rolls-Royce. So Rolls-Royce shares are actually up the most this quarter in the Stock 600, and they've gained considerably in Saxo's defense basket. So Rolls-Royce shares, for those that don't know, they make a lot of their money, you know, they're synonymous with car branding and cars, but they're actually quite significant in civil engineering and defense and power generation. So that's where they get the majority of their money from. And obviously civil aerospace, defense and power generation typically continue, and we know they do certainly continue to get contracts and can continue to get earnings and cash flow growth even in times of recession. So that's something to consider that is doing quite well. Just fast forwarding out, we already spoke about that. Gold is making higher highs and set to make higher grounds, but we don't think this might be the case until we get further evidence that the Fed is going to potentially pause. But that is that means back to you, Charu, with the next indicator this week, probably being the PCE. So what are you looking at this week?
Yeah, absolutely. PC is going to, I think, be important, but that's like really at the tail end of the week. And before that, I think the focus will still stay on banking sector. And, if we do see any further measures from the US authorities, they still say they're contemplating, supporting smaller banks and stuff. So I think the focus squarely still on banking sector developments. But yeah, you said it right. Jess, I think inflation still continues to be top of mind for central banks. We saw that, with the rate hikes, ECB going for 50 and then Fed following up with the 25 as well. But also on Friday, we had a lot of Fed speakers who kind of continue to talk hawkish and continue to bring the focus back on inflation. Whether the markets do it or not, I think we still need some more data, some more evidence of that going from here, and obviously some more peace on the banking sector front. But I think it is, I think, really still top of mind. Inflation really is still top of mind for central banks. But just maybe briefly, for switching gears to FX, if you're going to again see my slide here. So last week we had the US dollar, which was broadly lower, with the Japanese yen and euro leading the way, and Aussie dollar and Kiwi dollar being the laggards because risk sentiment stayed weak. Now, like I said, this week we get a fresh test on inflation. So I think US PCE, which is on Friday, expectations are a bit mixed for that. We had, if you look at its drivers, we had February core CPI, which came in higher than expected on a month-on-month basis at least, but the PPI was cooler. Now PCE kind of drives from both the core CPI as well as PPI, so expectations are rather mixed. For core PC, it's expected to rise 0.4% month-on-month, which is cooler than 0.6% in January, but the annual rate is seen still quite firm at 4.7% year-on-year. I think again, here the big question is that the market continues to price in about 100 basis points of rate cuts for this year, defying what the Fed's dot plot projections have been. And if we do see another miss in PCE, that could give further weight to these market expectations of a rate cut. On the other hand, I think for the PCE to be hot, it will have to be extremely hot to really shift the focus away from banking sector troubles. So I think the risk is more on a cooler print, I would say. And if you do see a cooler print, that could bring bond yields lower. It could boost the rate sensitive tech stocks, as we've been talking about again. we could see a further slide in the US dollar, mostly again against the yield sensitive Japanese yen, as well as the precious metals like gold and silver that Jessica just touched upon. The other key indicator that we have out on inflation this week is the euro area inflation as well. And there again, I think the consensus for the headline is inflation is expecting a broad softening, to 7.1% year on year from 8.5% in February. But keep in mind that this actually laps the 1 year. We've now reached the 1 year mark for the invasion of Ukraine, and that had led to a sudden spurt in European energy prices. So that is getting coming in the base effect, and I think that's a big driver of this easing that we will potentially see in Europe's inflation. So how much the market actually pays attention to it or not is going to be important. Core inflation still expected to remain hot, and if we do see a stronger than expected core CPI, that could still fuel more expectations of ECB rate hiking and more gains in the euro dollar as well. Again, as long as the further bank stress remains contained in Europe. Aussie dollar may get some pain if Aussie CPI is softer, and I think that will again obviously just take off some more yield from Australia. And we also, I think, are keeping a watch on the Chinese yuan. We have China PMIs due this week, which will be a fresh test of China reopening story. But that story has really been developing quite slowly. So we do need a real big push there to kind of move that in the FX space. But are there any key earnings that we're potentially watching, Jess?
Yeah, so we do have a couple of key companies that are out. I guess a really important one to watch, if we can just show these slides. Oh, I think, sorry, pardon me, we're just having some difficulties with the slides. So, okay, so I think Tuesday is going to be a really significant day. So we've got BYD, a very large EV giant in China. So it's pretty much been Tesla and BYD neck on neck in terms of EV growth. So that's going to be one particularly to watch. Pivoting down to Thursday, another vehicle, also increasingly dominant in the EV space, of course, Great Wall as well. So another significantly large motor company in China. And a consideration, as we just said earlier, with the lithium price down about in the order of 50%, you're probably going to see some strong outlooks from these companies. So that's something to keep on your radar. So if we do see a stronger than expected outlook, obviously that would support upside in their shares. Moving on to Walgreens on Tuesday, we've spoken about safe haven sectors previously and a lot of our commentary last week. So what's a safe haven sector? It's typically a sector that continues to see earnings growth in a recessionary climate. So Walgreens, obviously one of the largest biotech, but medical supplies in the US. So Walgreens has, I guess, they've been coming into a little bit of scrutiny on the back of an abortion pill sale, but that is not likely to have a material impact. That's according to Bloomberg Intelligence. But all in all, probably expecting to see some sustainable growth there from Walgreens. So plenty of earnings to sink your teeth into. And then, of course, tonight in the US, we get Carnival. So Carnival shares have been doing quite well year on year, but we know that their outlook might not be as strong as it has been over the past 12 months. And that's on the back of recessionary concerns creeping in and likely consumer discretionary spending likely to cool down. But back to you, Charu, with what else you're watching.
I'll just probably put up the summary slide here. Jess, if you could help to share the slides again, or are we? Is it a problem from my side? Sorry.
Yeah, no, it's all good. There's slides there.
Okay, great. Okay, great. So yeah, of course, I think importantly, we're still watching the banking stress indicators there, and both in US as well as in Europe, we get some focus back on inflation potentially with those PCE and European CPI releases, but also I think fresh test of China reopening, as I said, PMIs, but we also have a slew of China companies that are reporting earnings. I think Jessica's just mentioned BYD, but there's also oil companies, PetroChina, there's a top lithium producer, Gengfeng, reporting, and some Chinese banks as well. So I think we just continue to get that, further input on the China reopening story here. Especially remember that Tencent and, Meituan reported strong earnings last week. So I think Jessica did discuss commodities as well, where you could potentially, I think we get a fresh test from gold on the 2000 level. Can it continue to rise above that, and can silver play catch up? And oil obviously has been suffering quite a lot. And does it continue to stay below 70, or we get that China demand coming back? Brings some amount of help to oil, and we see it back above $70. Overall, of course, it's a month-end, quarter-end flows, which will be dominating for Japan. Particularly, it's the year-end as well. And let's continue to watch what that means for markets, and also obviously for US dollar, where we could potentially get another leg lower unless we do see those hawkish surprises in inflation data. But I think, that's it from me. And we could maybe, Jessica, do you want to add something? We could just take to the last slide as well.
No, I think you've pretty much nailed it on the head, but I do think we do have to say that some clients are actually increasing their options on oil. So although we do have some recessionary concerns and the oil price is down about 14% this quarter, as we were saying, we do have to consider that a lot of investors are actually quite long in oil, but some are cushioning their portfolios, are putting out options to protect on further downside. But that is it. That's all I wanted to share. So I think we'll just leave it there, shall we? Any questions, feedback, or comments, please reach out to your relationship manager or your global sales trader or your friendly team at Saxo. And I guess on behalf of Charu, Chanana, and myself, Jessica Amir, we bid you a wonderful week ahead. Stay tuned to our daily commentary.
Thank you for tuning in, and stay safe out there. Okay, bye.
Bye-bye.